We're calling this podcast Caught Between a Rock and a Hard Place, as we reminisce to a meeting I had with many investors in KZN in March 2002. We compare that period to what it feels like today, November 2019. One of the key functions of money managers is to identify moments of asymmetry of payoff. This is when the returns are significant versus the risks being taken. 2002 was exactly such a moment. At that time, the S&P was trading on a P of 40 on relatively high earnings. In comparison, the JSE, most stocks were on Ps of below 10 on relatively low earnings. If we take the 10 years after 2002 and go to March 2012 and look at the payoff of betting on South Africa and not the US, the South African market did 400% over those 10 years. The currency appreciated by 40% against the dollar, and the S&P actually returned 65% over 10 years. It was clearly a time to be invested in South Africa and not in developed markets. Now the question we ask ourselves, is that asymmetry appropriate in 2019? It feels quite similar. South Africans are externalizing their capital. On a PPP basis, we get the rand at about 12 Rand 50 against the dollar, 15% undervalued at its current level. And then if we take a slightly more sophisticated way of looking at markets, yet relatively simple in terms of a cyclically adjusted PE or Schiller PE, the S&P trades on 28 times, which is almost double its long-term average, versus the JSE at about 17 times, in line with its long-term average. The question we're asking ourselves, statistically, what kind of returns does one get by buying those markets with those kind of ratings? And actually, if you take a 10-year perspective, looking at a Schiller multiple on the S&P at these kind of levels, historically, your prospective returns in real terms have actually been negative, around minus 0.5% annualized. In fact, there's less than a 30% chance of getting a 1% real return annualized over 10 years on the S&P. Let's compare that to the JSE using the similar metrics. On a cyclically adjusted Schiller PE basis, of its current 17 times multiple, the JSE actually historically has delivered 8% real return on a 10-year basis, annualized returns. In fact, there's more than an 80% chance of getting a 1% real annualized return out of the JSE off its current Schiller PE rating. So isn't 2019 November just a repeat of March 2002, where it's easy to tell investors, tell potential clients to invest in South Africa and ignore offshore markets? Well, we think it is different this time around. And we cite one particular reason for that. It's the fact that South Africa's GDP growth, both in nominal and real terms, is at very low levels. What concerns us about nominal and real GDP growth is that we fail to see easy wins in terms of improving this. And there are three factors that really concern us. The first is crowding out by government, its intention to invest in the economy at the expense of the private sector, Eskom being such a good example. Two, inappropriate socialist regulations at the expense of the market. We've seen this in the hospital sector, in mining, and just of late in telecommunications. And thirdly, South Africa's issue around a debt trap and the potential for a downgrade, all of which do not provide easy stimulus to get GDP growing again. So what are we telling our clients? Well, quite frankly, this time is different. We're caught between a rock and a hard place. We have expensive developed markets, which were easy wins for our clients over the last 10 years, and we have very cheap but relatively risky domestic markets. We've decided to move to a very balanced approach. We feel the risk of massive capital loss offshore is low, albeit that markets are quite expensive. Whereas in South Africa, there's enormous optionality, but with potential tail risk. Consequently, we're informing our clients to have a balanced approach and not to externalize all their capital at current levels, but to be pragmatic and have a decently balanced portfolio with both offshore and domestic exposure.